Financial Accounting, BADM 211, Accounting for Merchandising Businesses, slide 3 of 3. This is the final of 3 videos for Chapter 5 that talks about how we do accounting for a retail business. The extra complications occur with the fact that we've got inventory to deal with. That the sale in this business is not just a service, but it's also got inventory. So first, let's talk about the fact that merchandising businesses normally have a multi-step format. Not all of them, but most of them have a multi-step format. And this just gives more information to the users. So the first thing I can tell you about a multi-step format is that it's just got an extra step or two, which includes an extra, what I consider to be a subtotal or two. We're going to have income before taxes. We're going to have gross margin or gross profit. We're going to have income before operations. So watch real closely. These are not new accounts that we're introducing. These are new subtotals or new steps, new stopping points, so that users of these financial statements have just a little bit more information to be able to make decisions and to use it for comparison. We haven't really talked about this very much, but in the financial statement world, we're not really looking at one company by itself for 1 year. Instead, we look at that company compared to prior years within the company or compared to other companies. So Walmart, for example, will look at 2015, 16, 17, 18, or they'll look at Walmart and compare Walmart's numbers with Target's to see which one has the strongest company. So multi-step versus single step. Multi-step is more complicated. It has these subtotals, and generally multi-step is going to be working through a company that has merchandising or manufacturing. Remember, a manufacturer makes and sells products, whereas a merchandiser buys and sells products. So service company, just services, merchandise. When we compare a multi-step company with a single-step company, first let's look at the single-step company where we've got revenues and then just operating expenses, income from operations, income before taxes, and then net income. Look at all these subtotals. Step 1 is a subtotal. Step 2 is a subtotal. Now let's go to a multi-step operation for a merchandising or manufacturer. They've got cost of goods sold and then a stop here, a subtotal. Then they've got operating expenses and then a stop or a subtotal. Then they've got other revenues and expenses, stop, subtotal. Income tax expense, stop. And the final subtotal, I guess we could call it the final total, is net income. Just lots of stops as we go through. So every time you see the word step 1, step 2, step 3, these are not new accounts. These are subtotals. So don't forget the items here, and that is that frequently you're going to see the word net sales. Net sales are taking the gross sales and subtracting out returns and allowances. So a store may have $1 million worth of sales, but if the customers do a lot of returns, they may only have $950,000 worth of net sales, because if they subtract out the returns and allowances. Gross sales are revenue recorded, and sales returns and allowances are the refunds and credits on the account. Just wanted to add something, and this is that for control, a business manager needs to know what the returns and the allowances are. So think about yourself as a business owner. Wouldn't you want to know how many times and what the dollar value was of your customers that weren't satisfied or that found that the product was defective and they returned it to your store? That's why sales returns and allowances is an important part in our internal controls of a company. It's also been found for fraud, and sometimes customers fraudulently return things after they wear them. For example, in a retail clothing store, It's been found that customers will buy an item of clothing and then they'll wear it and then they'll return it, or they'll use it and they'll return it. And I think owners need to be aware of these types of fraudulent activities so that they can keep track of it. So returns and allowances help owners to know what to do within their company. Cost of goods sold, as we've talked about, is an expense. It's the cost of the merchandise sold during an accounting period. Always remember its cost. Gross margin, also known as gross profit, is the difference between net sales, which is the sales price, and the cost of goods sold, which is the cost of the inventory. Let's go back to a prior example. If a store sells one t-shirt for $20 and the cost of that t-shirt is $8, then the sale is $20, cost of goods sold is $8, and the gross margin or gross profit is $12. And that's the gross amount received before they subtract out the other types of operating expenses. Operating expenses are also known as SAG. That comes from selling, general, and administrative. So some individuals, some people will term it SAG. Selling expenses, everything from advertising, sometimes it's delivery costs, promotions. General and administrative is going to be your accounting or your credit checks, collections. It's going to possibly include property taxes. There's so many different types of operating expenses that we'll find in future chapters. Sorry, I had an interruption with my front door opening, and that's what happens when you're making video recordings. Okay, we talked about SAG, selling expenses, general administrative expenses. The next is a subtotal called income from operations, and a lot of businesses use this as an important measure of how much money do they make from their normal operations. So a company may manufacture or sell a certain product, but every now and then they'll have a different type of revenue and expense that's just an anomaly, something that just popped up and it isn't a recurring event. So income from operations is the zero-in key point that people should look at when they're examining a financial statement to be able to see how much money the company earned. Because next we go to other revenues and expenses, and these are those not related to the company's operating activities. So let's take Boeing. Boeing sells aircraft, Boeing services aircraft. But Boeing also may have a piece of land or a piece of equipment that it sells. Boeing may also earn some interest income, and that may be part of their other revenue and expenses. And it's important to separate these types of revenues and expenses from their income and expenses from operations. Income before income taxes, companies always like to separate their income taxes, and this should say essentially income tax expense, because this is the expense for all the taxes, and companies always like to point out we can't control the taxes that we pay, so they like to separate income before taxes, then they'll record their income tax expense, and then they'll record their net income, and that's the amount of income that's going to go to the shareholders. So here's an example of a multi-step income statement for Net Solutions. It's from your text. Notice sales, subtract out cost of goods sold to get out gross profit here, which is your profit margin. It's also called gross margin. Here's your SAG, all these operating expenses. Here's a listing of the types of selling expenses, a listing of the types of administrative expenses. Here's our total operating expenses subtracted from gross profit to find out that this company has income from operations of $82,240. They have other types of revenue, another type of expense, interest expense, and their net income is $80,400. For this example, there are no income taxes, but we will find in future chapters that there will be income tax expense included. Wanted to point out the format because we haven't talked about this. Let me change so that my pointer option is a highlighter. Okay, notice this shows that this is the income statement for the year ended. Notice gross profit is listed here. subtract out operating expenses to get income from operations, and then come down to net income after you subtract out other revenue and expenses. Sometimes this is going to be a plus, sometimes it's going to be a minus. A lot of students get confused by the fact that we've got these columns. When do we use these columns? Well, if you wanted to, you could have put everything in this line item right here, but it's not necessary. It's just helpful whenever you start putting these columns in here so that readers and users of these financial statements can delineate because they're separated into a column. So this is just showing the total of all the selling expenses, total of all of admin, and here's our total operating expenses, also known as SAG. Here's our total other revenue and expenses, but the bottom line is right here. So it's only the more sophisticated and educated user that knows how to take advantage of all of the details of information that are here. And as I've said before, compare this to prior. This is an example of a single step for net solutions. Notice in this one they've got total revenues, total expenses. We have the exact same net income, you just don't have all that broken down. You don't have a lot of details. And it's completely up to the company as to the types of details that they want to present, because these financial statements are for users. So generally accepted accounting principles that we talked about in the first chapter, GAAP, requires certain formats, but companies can manipulate those formats to their best advantage and for the best use whenever they prepare these financial statements. In Chapter 1, we learned revenues minus expenses equals net income, and we're still there. We're just showing lots and lots more details, particularly if we were to get into a company that has a product or goods that they sell, because then suddenly they've got this expense. Last reminder, cost of goods sold is an expense. Chapter 5 has a whole lot more information, but we will not discuss Objective 4, and we're not going to go over the appendix. If you plan on majoring in accounting, I'd suggest you look through these to at least get familiar with the terminology. But there is a lot of detail in this chapter on the transactions related to periodic inventory. We will not be covering that at this time. We only cover transactions for perpetual inventory. There are also transactions related to adjusting entries and closing entry for merchandising. We will not be covering that. So this concludes Chapter 5. Our biggest summary is that this is the chapter that discusses transactions related to perpetual inventory methods, talked about how you have to reduce inventory with a perpetual inventory method. We discuss how inventory is accounted for. We talked about a multi-step and a single-step income statement, and we went through lots of types of transactions related to everything from freight to sales returns and allowances and the terms of a sale. Best of luck with your homework and with the quizzes, and as always, please let me know if you have any questions.